In continuing the discussion on business expense deductions, there are some statutory limits for certain types of business expenses. And so we have a couple here, and then we're going to talk about a few more examples on some future slides, just because there are some examples that are a little more involved. But these two here are kind of the more straightforward statutory limit examples. So the first one is any expenditures against public policy. So fines, bribes, lobbying, political contributions. For those types of expenses, there is no deduction allowed for those types of expenses. And the reason why, so like in the fines and bribes part, the reason why those expenses are not deductible is because, like, if you think about it, you don't want to reward a taxpayer by allowing them to deduct an expense for something that was illegal or where they broke the law. Like, that just intuitively doesn't make sense. You wouldn't want to do that. For lobbying and political contributions, on the other hand, a deduction is not allowed for those expenses because the way the textbook explains it is it frustrates public policy. There are laws out there like where corporations can participate in lobbying or have political contributions, but there are limits to how much you can do, just because we don't want to have corporations having too much influence on the politics. So then for the tax side, it almost kind of seems easier just to not allow a deduction for those types of items. It almost kind of seems more fair that way. The other example we have on this slide is expenses related to tax-exempt income. So here, what that bullet means is expenses that are generating or creating tax-exempt income are not allowed to offset taxable income. So examples of that kind of scenario are where a business might borrow money and then they incur interest on that loan. And then the proceeds of that loan were invested in municipal bonds. And we know municipal bonds are tax exempt. Another scenario where that could happen is with key employee insurance premiums. So a business pays for these life insurance premiums, and then if that employee, that key employee, were to pass away, the benefit from that life insurance policy is not taxable. So in both of those instances, it's preventing the mixing and matching of taxable and non-taxable income and expenses. We want to keep the expenses related to non-taxable income in the non-taxable category, and then vice versa. Expenses that are generating taxable income, those would offset our taxable income. The next set of statutory limitations apply to capital expenditures. So whenever we think of capital expenditures, we can briefly turn on our financial accounting brains for a second and think about different items that we can capitalize. So we can capitalize tangible assets. So things that we can touch, like buildings, equipment, machinery, office furniture. And then the intangible assets, those can also be capitalized. So intangible, I like to think of things that we can't touch, like a patent or goodwill. So typically, items that are capitalized for tax purposes. So we'll switch back to our tax accounting brain. So capital expenditures, or an expenditure that is made, it can be capitalized if that expenditure provides a future benefit beyond this year. So if we kind of think back to some of those examples, so buildings, machinery, furniture, patents, goodwill, those kinds of things. The benefit from those items usually are around for longer than 1 year. So that's what allows us to capitalize them rather than just immediately deduct them. There are some items to keep in mind for prepaid expenses, and we are going to look at this 12-month rule in an example problem on the next slide. But for prepaid expenses in the 12-month rule, you can deduct prepaid expenses if the benefit is less than or equal to 12 months and the benefits do not extend beyond the end of the next tax year. The 12-month rule does not apply to interest expense. Does not apply to interest expense. And then additionally, the 12-month rule is a little harder to apply for accrual taxpayers because of the economic performance principle. And we will talk about that in the second video with an example problem demonstrating that economic performance concept. But for now, we are going to flip to the next slide and look at an example problem for the 12-month rule. So in our example problem for the 12-month rule related to prepaids, Ben, a cash basis taxpayer, makes the following payments on June 30th of this year. $10,000 for the next 10 months of utilities, $12,000 for insurance over the next 24 months, and $9,600 for the next 8 months of interest on a business loan. What amounts are deductible this year? So for the utilities, here, Ben can deduct all 10,000 of utilities because the benefit does not exceed 12 months. So we see here that's only for the next 10 months. So it doesn't exceed 12 months and it does not extend beyond the next year. For the insurance, here Ben can only deduct $3,000 for insurance. And the reason why is because the benefit here exceeds 12 months because it tells us in the fact pattern that it's for the next 24 months. So since this benefit exceeds 12 months, we can only deduct 6 months worth of insurance for this year. So if we take our total of $12,000, divide that by 24, and then multiply it by 6. So as a tip for the exam, Whenever you see problems with expenses, pay very close attention to your dates. So then that way you count out months correctly. So since all of these were paid on June 30th, so at the end of June, during the tax year, we paid for 6 months of insurance. So July, August, September, October, November, December. We'll go on a quick side tangent here. If this had said the following payments were made on June 1st of this year, then we would calculate 7 months worth of expenses. So June, July, August, September, October, November, December. So in this case, we are dealing with 6 months. And so then that should get us to $3,000. Then for our last expenditure, we had $9,600 for interest. The amount that can be deducted for the interest is $7,200. And the reason why is because the 12-month rule does not apply to interest. And so the way we get to that $7,200, the way we get there is if we take that $9,600 divided by 8, because we paid it for the next 8 months, and then multiply by 6. Another type of expense that has some statutory limitations are business expenses that have a personal benefit. So if an expense is purely personal, no business deduction is allowed for that, because ideally our business expenses should be whatever is ordinary and necessary to run the business. So for example, very basic example, if a sole proprietor had accidentally used their business credit card to purchase groceries for the family, those groceries would not be considered a business expense and would not be allowed to be deducted. There are some instances where expenses can have a mixed business and personal motive. And so whenever those arise, the way those are treated are based on whatever that expense is. So in some instances, the amount that you can deduct is all or nothing, depending on whatever the main motive was for that expense. So an example of that is travel. So anytime that you are away from your home overnight, that primary motive of whether it was personal or business travel will influence whether or not you can deduct it. Other expenses will have an allocated deduction to the business. So for example, meals are allocated based on an arbitrary percentage. So typically for meals, you can deduct 50% of the cost of meals. And there are some special rules to that. So like making sure the meal is ordinary and necessary, not extravagant. The taxpayer or an employee of the taxpayer must be present at the time of the meal, and the meal must be provided to a current or potential client. And then also if the meal is provided during an entertainment activity, the meal must be purchased separately, or the cost must be able to be separated from the entertainment. So like if you have an itemized invoice, that kind of thing. Otherwise, there are expenses that can be allocated to business and personal based on some sort of allocation basis. So those different bases could be like mileage. If you have a vehicle for your business, like let's say you're just starting a business and you're kind of bringing your truck over from like personal to business use, for example. If you track your mileage, so like how much are you driving the truck for your business, then whenever you incur expenses related to the truck, for example, then you can use the mileage to allocate, okay, of the repairs I had to pay for example, how much of that repair is related to business and how much would be considered personal, that kind of thing. It's not listed on here, but another type of expense to keep in mind is entertainment expenses. And typically, entertainment expenses are not deductible as an expense. So, like personal expenses, they cannot be deducted. And for all of these different types of items, it is important to keep in mind that as you're incurring these expenses, you want to make sure you are having substantial documentation to support the business purpose behind the expenses, especially if something is mixed motive, like travel or meals, that kind of thing. Because having that documentation will be helpful if you are ever audited for some reason, or if a taxpayer is ever audited for some reason. And then having that documentation and having that support can help the taxpayer defend their position against the IRS. Let's look at a comprehensive example of some mixed motive expenses that a business could potentially incur. So in our example, Ben paid the following to attend a business meeting in Chicago: airfare of $1,200, a hotel for 3 nights was $750, and meals for 3 days was $270. And so our questions we want to answer are: what amounts are deductible if Ben spent 2 days in meetings, making it primarily a business trip? What amounts are deductible if Ben spent 1 day in a meeting, making the trip primarily personal? And then what amounts are deductible if the meals were provided by a restaurant outside of the meetings? So since we have some details about days, so we have notes about like whether something was 2 days versus 1 day. I'm gonna make some quick notes off to the side over here, so we have some daily expenditure amounts. Then that will help us with allocating between business and personal as we work through the problem. So airfare, as you recall from the previous slide, airfare costs are one of those all or nothing expenses in determining whether it's business or personal. So we will leave that one as the full $1,200. And then items like the hotel and meals can be allocated based on whatever that allocation method is. So whether there's the percentage like the meals or time like the hotel. So for our hotel, we have $750 in total. If we divide that by 3 nights, that gets us $250 per day. Same with the meals. We paid $270 in total for 3 days. So then if we divide that by 3, that gets us $90 per day. So here I'll add per day. Okay. So now, since we are comparing a primarily business trip versus a primarily personal trip, I will add some columns over here to separate our numbers. So this will be business, and then this will be personal. And I'm going to try to draw some lines across to keep our numbers organized. Ooh, we'll see how this goes. Eee. Okay. I think that'll work. Alrighty. So if we go through each expense, and we'll compare the business and personal side by side as we go through. So for airfare, if it's primarily a business trip, airfare is one of those expenses where it's either all or nothing, depending on the motive. So since it is primarily business for our first question, we are able to deduct the full $1,200. I know I said I'll go back and forth between business and personal, but now as I'm thinking through it, I think I'll go through the entire business example and then the entire personal example, just so we can keep them both straight. So I will stick with the business scenario first. Right, so $1,200 for airfare for the business trip. For the hotel, the problem tells us that Ben spent 2 days in meetings, making it primarily business. So of the $750, the amount that we can deduct for the business is $500. So that's the $250 per day multiplied by 2 days in meetings. Then for the meals, we can deduct $90. And the way we calculate that is $90 per day times 2 days, since we spent 2 days in meetings. Then we multiply that, so 90 times 2 is 180. And then multiply that by 50%, and so then that gets us $90. And then the total, so I will do the total next to the question. So the total travel deduction under the 2 days in meeting scenario is $1,790. So that's the $1,200 plus the $500 plus the $90. Now let's go to the primarily personal trip. So under the primarily personal, Ben spent 1 day in a meeting. So now if we go through each of the expenses, for the airfare, that one is either all or nothing, depending on the motive. And so for this scenario, since it's primarily personal, the amount of airfare that we can deduct is 0. For the hotel, since we only spent 1 of the 3 days in business meetings, the amount that we can deduct is $250 per day. So then 250 times 1 is $250. Then for the meals, the amount that we are allowed to deduct is $45. And the way we get to that is we take our $90 per day for the meals, multiply that by 1 day, because we spent 1 day in a business meeting, and then we multiply that by 50%, and so that gets us 45. So then under our primarily personal scenario, the total travel deduction that we can take is $295. So the 250 plus the 45. Then our final question, what amounts are deductible if the meals were provided by a restaurant outside of the meetings? So for that question, the cost of the meals would still be 50% deductible, regardless of whether they were provided by a restaurant, because the meetings were away from home overnight. The next type of statutory limitation we want to talk about is limitations related to business interest. So, the business interest limitation does not apply to a taxpayer with average annual gross receipts of $31 million or less for the prior 3 taxable years. So essentially, if we think about that statement, that's essentially talking about the gross receipts test. So another way to think about it is the business interest limitation does not apply to businesses qualifying as small businesses under the gross receipts test. High level, the business interest expense deduction is limited to business interest income plus 30% of adjusted taxable income. So we'll want to keep this formula in mind here. And then this adjusted taxable income, what this is it is taxable income that is able to be allocated to the business, and that is adjusted by subtracting interest income, excluding investment income, adding interest expense, excluding investment interest expense, and then adding any depreciation, amortization, depletion deductions, net operating loss deductions, and Section 199A deductions. And so we are going to work a problem that talks about all of this information on the next slide. What this slide doesn't include, but it's important to keep in mind, any business interest expense not allowed as a deduction for any taxable year is able to be carried forward indefinitely. Additionally, if a business is able to qualify for that small business classification, then the interest and any carry forwards become fully deductible. So I guess another way to think about it is this business interest limitation is more geared towards those businesses classified as large businesses. So let's take a look at an example problem. So here we have this year, MH Incorporated reported $200,000 of taxable income on greater than $31 million of revenue. So that's important to know because that means that they are considered a large business because they had greater than 1 million of revenue. The revenue included $20,000 of interest income. In calculating the taxable income, MH deducted $240,000 of depreciation and $210,000 of interest expense. So what is MH's maximum business interest deduction this year? So let's work through the calculation for adjusted taxable income. So essentially we are going through the 30% of adjusted taxable income first, because then the business interest income piece will be pretty straightforward. So we'll get the harder piece out of the way first. So adjusted taxable income, how we will want to get there is if we start with our taxable income of $200,000. So let me get that highlighted here. So we had $200,000 of taxable income. Then, if we think back to the previous slide of how that's adjusted, we will want to subtract $20,000 of interest income. Then we will want to add back interest expense and depreciation. So if we add those two back, when we combine all of those together, we get adjusted taxable income of $630,000. Then if we multiply that by 30%, that gets us $189,000. So then that completes the 30% of adjusted taxable income step. However, the business interest expense deduction is limited to 30% of adjusted taxable income plus business interest income. So in the problem, we know our interest income is $20,000. So that's this sentence right here. So then if we add that $20,000 in interest income, our maximum interest deduction that MH can take is $209,000. The last type of item that has some limitations are related to the sales of business assets. So this conversation here is going to be pretty high level because we are going to talk more about property dispositions in chapter 11. So it'll be the very last topic that we talk about. But for this discussion, just to kind of plant some seeds and get us thinking about it, whenever we sell business property, typically those losses are deductible. However, if that loss was from a sale to a related party, then those losses are typically not deductible. And so a related party or related persons, that's typically family members, partnerships, and controlled corporations. Another type of loss that we want to think about is business casualty losses. So business casualty losses are different from like the typical losses we would see, because what we just talked about, that loss came from selling a piece of business property. But a casualty loss is a loss that comes from an event where an asset is stolen, damaged, or completely destroyed by something outside of the business's control. So that's what makes it a casualty. So casualty losses are deducted in the year that the casualty occurs, or if it's related to theft, in the year in which the theft is discovered. And so the loss in the textbook for a casualty, the amount of the loss deduction depends on whether the asset is completely or partially destroyed. Whenever the asset is completely destroyed, the loss is the amount of the insurance proceeds minus the adjusted tax basis of the asset. Whenever an asset is partially destroyed, the amount of the loss is the amount of the insurance proceeds minus the lesser of the adjusted tax basis of the asset, or the decline in value or repair cost of the asset due to the casualty. That concludes this section, and I will see you in the next one.